Was it sold as temporary, or this is here to stay forever?
Income tax is always intended to be temporary. And then what happens is the government goes, hey, look, we've got all this money. We can do all these projects. They kind of like having all that money and that power.
So under a Biden tax plan, who wins, who loses?
I actually think everybody loses.
Somebody who has amassed $100 million of wealth with Biden's tax laws could potentially only transfer upon death only 2 million of that 98 to their heirs.
Correct. And 98 million would go to the government. There was always a question whether a tax was even legal until we got the constitutional amendment.
Out of all the tax increases that we can have, capital gains, certain write-offs, corporate taxes, which one hurts the economy the most?
Taxes on small business hurts the economy the most. When they say that the rich don't pay a lot of tax, they kind of imply that it's because they're cheating. But what I find, they just have better tax advice.
My author today is an expert in taxes, but he looks at taxes in a very different way that hopefully by the time you're done watching this interview, you will also look at taxes in a incentive compensation structure type of way. He's fully qualified to speak on the topic of taxes. He was with Ernst & Young for many years, also with PwC. At one point, he was training thousands of CPAs that were coming through Ernst & Young. At the same time, he was an adjunct professor at Masters of Tax program at Arizona State University for 14 years. And he wrote a book called Tax-Free Wealth. With that being said, Tom Wheelwright, thank you so much for being a guest on Valuetainment.
Thanks for having me, Patrick. Great to be here.
So there's a lot of things to like. Why do you like the word tax? Why do you like learning about taxes? Tell us.
Well, Einstein said that the most complicated thing in the world to understand was the tax law. I'm going, why not take on the most complicated area? If Einstein thought it was hard and if there was a way to make it simple for people to understand, then that sounded like a good thing to do.
So unpack that for me. So because the way you explain taxes is a lot more simpler than sometimes others explain. How do you view taxes from your lens?
Well, so I look at taxes as really what most of the tax law is. So there's 6,000 pages in the US tax law, roughly. There's about 30 pages that actually give you the rates and how much tax to pay. There's one line that says all income's taxable unless we say it isn't. There's another line that says nothing's deductible unless we say it is. Okay, so that's 30 pages. There's another 5,970 pages. And what is that? Well, primarily, it's really incentives that the government uses to encourage people to undertake certain behaviors, whether it's buying a home versus renting a home, whether it's sending your kids to college, or whether it's starting a business, investing in energy, whatever it is. So if you look at it as this is really just an instruction guide for reducing taxes and doing what the government wants you to do, all of a sudden it completely changes the picture and your view and your outlook on taxes.
So can you walk us back? Because one of the things, I got 50 pages of notes on taxes, history of taxes, okay? So I'm enamored by the topic of taxes because I look at taxes as if you're in a company that pays you commission and you see how the sales commission is structured, and you have to figure out a way to maximize the compensation structure of a sales company. You're doing real estate, you're with Keller Williams, you're with Compass, you're with whoever. Here's the comp structure. You're with insurance, you're an advisor at Morgan, you're selling pharmaceutical sales, there's a compensation structure. Walk us through the history of taxes. I don't know how far back you can go, but specifically in the States, walk us through how taxes became, why it became, started, and where we are today, how much more complex it is today versus what it was in 1913 when it first got started.
So remember in 1913, it was only a tax on surplus income. It wasn't a tax on all income. It was really a tax on what they called excess earnings. And it really only applied to the very wealthiest people. Around 1944, they changed the law to apply to employees, but even then they exempted a living wage. So basically the standard deduction, the personal exemptions, they were intended to exempt a living wage so that only the excess earnings, again, were taxed. And then in the 1960s, we started to see some tax increases, and we started to see incentives. We had the 1954 Act, which was a major tax act. It was supposed to simplify it, didn't it? Complexified things. Then we had the 1986 Act, which is supposed to simplify again, which is what it really did was broaden the base So it made more things taxable, added more complexity. What we have now is we actually have a lower tax rate than we've had in many, many years in the US. At one point, it was upwards of 90% on the highest rates. And there's all sorts of shenanigans going on to get out of those, right? Those kind of 90% taxes. So right now, we're in that 40% range, which is actually kind of a sweet spot for governments. They find that if people are paying more than 40%, they have a huge incentive to get out of taxes. And if they pay much less than 40%, the difference between a lot less than 40% and 40% doesn't impact behavior a whole lot. So what the government really started doing back in the early 60s with the investment tax credit was to kind of test the waters and see what would happen if we gave a tax incentive. They finally realized people hate paying taxes, right? So if we give a little tax incentive, what will that change behavior? And what they found was, yeah, and in fact, it changes behavior. The right incentive will change behavior in a massive way. So really what taxes have become is a way for the government to leverage government funds. Instead of the government building houses, for example, they encourage private industry to build houses. And as a result, private industry does 10 times the work for the same number of dollars because they're getting rewarded through profits. And then when they make the profits, they're also paying the government. So the government wins multiple times with these incentives.
So let's go back to the one topic that always comes up is what's the big deal with 40%? Do you know at one point, the top marginal tax rate in 1944 was 94% for any income above $200,000, which is in today's correlation of $2.5 million. But then I've read by a lot of different people saying no one ever actually paid 94%. They just had it there, right? And by the way, if we look at the 90% tax rate, we stayed at 88% or higher from 1942, top marginal tax rate, till 1963. It was minimum of 88%, 48, 49, we dropped to 82%, but then it went back up to 91%. So first of all, if you can kind of walk us through, what does that mean, 94%, 88%? Did anybody ever pay it? How did people get around it? What was the cause of raising it to that level? And why do we get away from it?
Well, taxes are by definition a burden, right? So they drag something down. And what they found, and it was actually the Great Reagan experiment, right? And it actually started with John F. Kennedy. John F. Kennedy was the first president to really look at taxes as, what if we reduce taxes? Would that stimulate the economy? What if we didn't have such a high tax rate? Do we really need to have such a high tax rate? And what he found was, yeah, it actually did stimulate the economy. Of course, Reagan, I remember the Reagan years very well, not just because I was there in Washington, D.C. when that law was passed, but I remember when we had that stagflation and we had high interest rates and we had high taxes and we had low economic production. And so what Reagan did was he pretty much went in and turned it on its head and said, look, let's try a really low tax rate. Let's get rid of all of these tax shelters, which he did a pretty good job of. Let's get rid of the tax shelters that people were using to get out of that 90% rate. And instead, let's just have closer. Actually, that was the closest we've ever had to a flat tax. We only had two tax rates after the 1986 Act, right after the 1986 Act. So all Reagan was looking at was, look, we think that we could stimulate the economy. You look at the, Art Laffer and the Laffer curve and supply side economics. And that's pretty much where we've been since then. Going back to your question about 40%, there's been a lot of studies, and my reading of the studies is 40% is that magic number where you get much over 40% and people really stop doing what you want them to do. If you get much under 40%, that difference below 40% and 40% doesn't have a huge impact on the economy. So it seems to be some kind of a magic number. I don't know why that is, but interestingly enough, Patrick, it's actually not just the US that uses that 40% target. It's most of the world.
So who screwed up the tax system from 1913 till today? Meaning which president abused and raised taxes the most that created a lot of different opportunities for new tax laws to be created?
Oh, I don't think any one president could take the credit for that. there's a lot of opportunities. We're actually we have the highest compliance rate in the world. We're at 85% compliance rate, which is really good. It's so I was in Italy with Mr. Kiyosaki, and I was looking at the law in Italy. They actually have two levels of tax evaders. They have the little tax evader, which kind of they expect, and you just get a slap on the hand. And then they have a major tax evader that, goes to prison, so forth. We don't get that. Okay. You evade taxes, you go to prison. If you avoid taxes legally, you don't go to prison. And so that's really the key, is just stay away from cheating. What they're looking at right now is cheaters. And the cheaters, by the way, are not all the rich. That is completely false. And if you look at the data, it's primarily the middle income, and it's the small business where you get a lot of the cheating.
Oh, so tell me more. Can you elaborate on that?
Yeah. So for example, a small business. I mean, how many times, Patrick, have you had a contractor, somebody say, "Well, if you pay me cash, I'll give you a discount"?
Plenty.
Right? Well, that's just non-taxable income. They're not reporting that income. Yeah. Or you have a small business that reports what we call a Schedule C in the US. Well, a Schedule C is basically a one-sided entry. See, we have double entry bookkeeping, left side, right side. And the idea is that they have to balance, right? But in a Schedule C, a small business, they only report one side of that transaction. Well, that makes it really easy for them to fudge the numbers. And they find that a large proportion of the cheating goes on in that small business. It's just easy to do. And that's where the IRS does try to audit those, but the IRS has been hampered with lack of qualified professionals.
So if I look at the numbers right now, history of it, here's what it looks like. In 1931, our top marginal tax rate was 25%. If we go all the way back to 1913, it was 7%. So from 7% by 1931, we're 25%. World War I happens. We go up to 63 under FDR. By the time FDR is done, he takes it all the way up to 94%. In 45, that's the top marginal tax rate. Then comes Truman. Truman lowers it. He's a Democrat as well. Truman comes down and he takes it down to 86.5%. And then it goes all the way down under Truman. It goes back up to 92. Then comes Ike. Ike, 91%, keeps it 91 the entire time. JFK takes it from 91 to 77, a Democrat, Ike being a Republican. LBJ goes from 77, stays at 77. Nixon takes it from 77 to 70. Ford stays 70. Carter takes it from 70 to 69. Reagan takes it from 69 all the way down to 28%. And then comes everybody else. So many times when you talk about Reagan economics and the way he did his taxes was very interesting. He actually raised corporate taxes slightly. He lowered, he increased the bottom line marginal to, I think, 15% and matched it with 28. But what he did, you will hear a lot of people saying this trickle-down economics doesn't work. Trickle-down economics doesn't work. Trickle-down economics doesn't work. Can you give the argument of the people that say it doesn't work? What is their argument? And what is the argument for saying, no, it absolutely worked?
Well, of course, the argument for people who say it doesn't work is they're saying, look, that's such a low rate. Okay, when you get to 28%, the difference between 28% and 50%, say, is not going to change behavior substantially. And so you're not going to get a lot of bang for your buck out of that difference between 28 and 50. What Reagan did, though, so on the flip side of this, remember what the world looked like, and particularly the US economy looked like when Reagan came in. And he started, by the way, his first tax bill was his first year in office, was 1981. It wasn't 1986 when we had the flattening of the rates. He started with real estate. He actually gave huge deductions, incentives to real estate in 1981 under the Economic Recovery Tax Act of 1981, right? And so what Reagan was thinking was, look, what if we bring it down and we get rid of all the tax shelters? So there were massive tax shelters, cattle shelters, real estate shelters, all these other shelters that were going on prior to 1986. And so you never paid 90%. I mean, there's a famous case with Jack Benny. the comedian who was able to set up a corporation so that he paid corporate rates instead of individual rates of 90%. So people were, playing, they were playing fast and loose with the law pretty well. And it was pretty easy to do prior to 86. And what Reagan said was, look, what if we tighten everything up? So we actually are going to broaden the base. So we're going to take away a lot of the tax deductions, a lot of the tax shelters, and instead say, look, you really are going to pay tax. You're going to pay 28%. We're not going to say it's 90% and you pay 28%. We're going to say it's 28%, you pay 28%. Well, what it did was at the time is it takes all the incentive out of doing something for tax purposes. Well, actually what happened, Patrick, is the government doesn't actually like not having that tool. And so they started raising the rates almost immediately and started adding back in incentives. Okay, that's pretty much what happened. And the rate needed to get a little higher in order to incentivize people to reduce their taxes by investing in real estate, energy, et cetera. And so, the government actually has been tweaking this a long time, and they really just found, I think what they tried to do is tweak it to a point where it's both fair on the one hand, but it doesn't inhibit the economy, but it gives them some tools to do what they want to do.
Got it. Interesting you explained it the way you did. Back in the days, one of the biggest things that the government convinced the people to agree on is to withhold taxes before they get the money, right? So it was almost like before you get your money and then you would pay the tax. So you would get, if you made $4,000 this month, you'd make $4,000 this month. So they were able to get the people to agree, no, we're only going to pay you $2,800. We will withhold the $1,200. So you are okay with that because you won't really see the $1,200 being kept by the government. How would they? That's got to be one of the biggest sales of all time to convince them to do that. How do you convince the populace to say, don't worry about it, take 30% of my income before I even see it?
Well, you can even go one better than that, Patrick. Consider what happened in 2017 when Trump reduced the tax rates. Almost everybody got a tax cut. And yet the Democrats were able to say, this is a bad deal. Well, why did that happen? It really was because what Trump did at the same time was reduce the withholding rates. And so people didn't get as big a refund. They were pissed. They were upset with Trump because they didn't get as big a refund, even though their check was bigger. What they really wanted was the refund because they counted on that for vacations. Wow. Yeah. That was a savings. People do not like having to pay taxes on April 15th. Let me tell you, they would much rather get a refund. I don't know what it is about our psyche, but that seems to be the way it goes.
But do you know how the sale was made? Like, do you know the history of how they were able to convince the public? Okay, you don't know that. Okay, now in 1939, another interesting statistic for you. I'm curious to know what you know about this one. In 1939 in America, only 4 million people filed taxes, income taxes. This is 39. And the government collected $900 million. This is in 39. 4 years later, they went from only 4 million people filing taxes to 41 million. They went from raising $900 million in taxes to $13 billion. Do you know kind of what happened during that 4-year period, 39 to 43?
Well, yeah, we had a war is what was really going on, and what they were trying to do is raise taxes to pay for the war. That's what this was. But what happened was employees had never been taxed. Prior to 1943, 44, employees had never been taxed. And what they really wanted was they wanted the federal employees to be taxed because they were government employees. They said, look, we're giving you money, we're going to take some back. In order to do that, though, constitutionally, they couldn't just tax federal employees. And so what they did was they taxed everybody. And it does. All of the money is in middle income. That's where the money is. And so that's where they went for it.
Do you think it was, again, this is your world. It's not my world. This is why we brought you on, because I want to learn from you. Was it sold as temporary, or was it sold that this is here to stay forever?
Oh, for sure. Income tax is always intended to be temporary. It's basically a war profits tax. The idea is that it's a tax to pay for wars. Every time there's been a tax, even think about 1913, what we have? We had World War I, right? So it was a tax to pay for a war. World War II, it's a tax to pay for a war, right? And then it was supposed to actually go back and go away. I mean, the idea was it'll be temporary. We'll start at 7, 25, now it's getting higher, but this is just temporary. And then what happens is the government goes, hey, look, we've got all this money. We can do all these projects. And so they kind of like having all that money and that power. I mean, that's just the way people are.
That's insane to me to say, hey, guys, listen, we're going through tough times right now. We got to figure out a way to everybody take a cut. And they're like, it'll happen to the company. Let's just say you're running a mortgage company. It's 2007. Everyone's making money. In November, the rates change. No more, no income, no assets. Loan is going away. And you sit there and say, guys, I hate to say it to you, I can't afford to pay the salary I'm paying you right now. I have one of two choices. I either have to fire you or I have to pay half your salary for the next 12 months. I hope you guys are okay with that, because there's only this is the only thing I can do. People say, you know what, it's okay. I'll stick around. I'll be patient. But the idea is 12 months later, if there's recovery, I want to go back to my old salary, right? But in this case, they said, no, we're going to stay here. Now that we realize we can go from taxing 4 million to taxing 41 million, and you're not complaining about it, we ain't changing it. We're going to keep it this way. And the populace obviously accepted it.
Well, and you're right. The withholding was a key to that. Okay. Because it's a tax not seen is not a tax. When we look at it, it's the sales tax that we see on the bottom of our when we pay at a restaurant. That's what hurts, right? Because we see that tax number, but if we're not seeing it because it's just taken out of our paycheck, it's much easier to get that by the general public.
I mean, obviously it worked out, and fast forward 80 years later, we're not saying nothing about it, and we're just constantly sending the money to them. And, the government's gotten much bigger than what it was before, and it's very hard to back down. It's not a Republican or a Democrat thing. Both of them are spending a lot of money when it comes down to it. So that's the one part about the budget. Let's take a different angle right now. So President Biden's launched his tax plan. We've heard about it. Everyone reads about it. Capital gains is going to go from 20 to 39.6. So corporate tax is going to go from 21 to 28. Top line marginal ordinary income is going to go 39.6. And I'm not counting the additional Obamacare, which is the 3.29 or whatever the percentage is that you have to pay for. What are your thoughts about what's being proposed, and what do you think will get done? And will they be able to retroactively take it back to 1/1 of 2021?
All very, very good questions, Patrick. Let's start with the capital gains tax, because I think that's the most interesting one, because it actually doesn't raise revenue. Even the liberal think tanks say, look, this doesn't raise revenue. The government accounting office says this doesn't raise revenue. And yet they want to raise capital gains tax. And it's almost like it's we've got this big call to tax the rich. Well, I think what people miss is that the rich pay all the taxes to begin with, right? I mean, they pay 80% of the taxes. The taxes aren't 50% of the public doesn't pay tax hardly at all, right? And the other 50% is paying all of it. And most of that's being paid by the top 10%. So I think a lot of it is show. Now, the challenge with the capital gains tax, of course, there's the capital gains tax during life, which is bad enough. I mean, it affects markets, and there's a question, can you do that, and what will the impact be? But the capital gains tax at death is actually pretty serious, because there've been some calculations that if you follow Biden's tax proposals through, somebody with $100 million estate could easily end up with $2 million. His heirs end up with $2 million. But $98 million is taken by the government between estate tax and capital gains tax. So we're talking about a massive shift in policy.
Let me say that one more time, because the audience may have not paid attention to what you just said. So somebody who has amassed $100 million of wealth, okay, with Biden's tax laws, they could potentially only transfer upon death only 2 million of that 98 to their heirs. Is that what you just said?
Correct. And 98 million would go to the government.
If his tax laws pass.
If you follow it exactly the way, I mean, these calculations have been run, and not just by me. If you follow all of his proposals through, you've got to assume that somebody with if they have $100 million estate, it's probably a business, right? And they probably don't have any what we call basis for that. So when they if they sold that business, they'd pay capital gains right on $100 million. But they'd also, under what the plain language is, they'd also pay 45% estate tax, plus you have state income taxes, right? You can't ignore state income taxes. You know, when the Biden talks about this increase in corporate rates, like the federal rate is the only rate corporations pay, when that's far from the truth. I mean, some states charge a large portion of the taxes. So
do you mind if we do this together? I'm going to have my editors show this so they understand.
Sure.
Now, I'm tracking with you. So I got $100 million. I want to sell my business. How much of that $100 million do I pay in tax? And I'm in California, let's just say, or New York, because I see what you're doing. I'm in California. I got a $100 million business. I sell it. How much do I pay in capital gains taxes under Biden's laws?
So in California, just California alone, you're going to pay 13.3%.
Okay. So that's 13.3 million.
Okay. Biden, you're going to pay somewhere between 39.6 million. And depending on if you end up having to pay the Obamacare tax, that's another 3.8%.
Well, so you can't avoid it. So if you're living in, I'm paying a 3.8.
You literally could end up paying 43.4%.
So let's stay together. Let's
4% federal tax.
So at this point, you have me at 56.4 million is gone. I have 43.6 million left to my name. What else will I pay?
Right. But then you've got understand that you got a 45%. So you have $3.5 million exempt. So out of that 100 million, $3.5 million isn't subject to a state tax, but 96.5 million is subject to a 45% state tax. So you take 45% of 96.5 million and add that to your number, and I think you come up with right around 98. You see if I'm close there. I think I'm pretty close.
So I take 96.5 million at 45%.
Correct.
I get $43 million.
Right. Add it to what you got that you're already paying,
which is an additional 43 million. So that's 86 million. Let's just say it's a 90 million bucks right there.
No, because you've got, you got 43 million.
Yeah.
And then you've already got 56 million.
Yep. I paid 56. Oh, that's right. So it's 90. I got you now. So the 45 million plus the 56 million, that's
99 million. Just so you know, 43, okay, 40 plus 50 is 90, right?
That's $99 million.
53, right? Plus 5, that's 8, that's $98 million. So there's your 98 million.
And all of that, what you just said, could realistically happen to somebody.
It's possible. Hopefully saner minds will prevail. But if you just look at it honest black and white, hopefully you're not paying the state tax on top of income tax. You shouldn't have to, but that's kind of what the proposal looks like. So it's pretty much a confiscation of your assets when you die. So
under a Biden tax plan, who wins, who loses?
I actually think everybody loses.
Tell me why.
I don't think there are any winners. I don't think there are any winners because if you take away the incentives, do you still get, for example, do you still get the technology that we're creating? Do you still get the businesses? Business owners, we're business owners, right? And business owners take a lot of risk. Okay, are you going to take that risk if you can't leave anything to your kids? What happens to family farms? What happens to family businesses? You never have a second generation business. Do you think the average person is going to be happy when their neighborhood restaurant goes under because the government confiscated it? I'll tell you who the big winners are, actually. The big winners are big corporations, corporate America. They are the biggest winners under this plan, because what happens is if you had, let's say that you've got a small business, it's worth $10 million, but you get a $5 million capital gains tax at death. Okay. You get a $5 million capital gains tax at death. A $10 million business cannot pay that. They don't have the money. So what do they have to do? They have to sell it, but it's a distress sale because it's a fire sale. Who are they going to sell it to? Well, the people with the money. Who has the money? Big corporate America. So I actually believe, Patrick, that the big winners out of all of these tax plans is corporate America.
Okay, so let me be a skeptic here, and I'm going to go to conspiracy town for a second here with me. Let's see if there's anything that you say.
Awesome.
So I'm at a program in Boston with 144 other entrepreneurs from around the world, 64 different countries, and we're all learning about different laws and how it's played. In many different countries, it's very open how to manipulate the market by buying politicians out. It was very open when one guy's from Brazil. It's like, look, pay the guy $500,000 who needs to be reelected. If you're going to make 10 million on this, what's a $500,000? Just pay to the guy. Let him come out with a new law to make it higher to compete in the marketplace. So how much is happening in the US where guys are saying, look, a Biden or this camp, you win, great. I'll give up a little bit of taxes here and I'll be wink, wink. Yeah, we should raise taxes. But behind closed doors, I want you to eliminate 80% of my competition and I'll buy them at distressed sales. And rather than paying $100, 100 pennies on a dollar, I'll pay 50 cents on a dollar and I'm saving 50 cents. Who cares if I'm paying 10% more in tax? I'm still netting 40% more. How much of those conversations actually takes place? And how much of it is just conspiracy skepticism that'll never happen?
I actually think, I'm sure it takes place. Okay. I don't think it may not be the primary driver, but just look at what's happened during the pandemic. Who won and who lost? Small business got crushed. Big business made out like bandits.
Massive.
Okay. So now fast forward, now you're talking about new tax laws, right? And they're talking about raising the corporate rate from 21% to 28%. Well, it was 35% 3 years ago. Okay. And so you're raising it to still only half the way back to where you were. And then there's pushback. Well, maybe we could take 25%, but boy, that would be really tough to be competitive even at 25% because we've got state rates. In exchange, we get to buy out all of these small business at fire sale prices. I think that's a pretty good trade-off, frankly. If I were a big business, let me give you one more. So one of the proposals of Biden is to eliminate the like-kind exchange on real estate, right? Somehow this is some big loophole. It's obviously not a loophole, it's a code section. So here's what happens. So they eliminate it on real estate, which by the way, only affects middle America. I mean, the big guys don't use 1031 exchanges. They don't do that anyway. Okay, so that's who it's affecting. Okay, but remember who still gets who gets a like-kind exchange. That's a non-taxable exchange. Anytime a business acquires another business in exchange for stock, that is a tax-free exchange. It is exactly the same as a 1031 like-kind exchange, but they're not even talking about getting rid of the tax benefits of mergers and acquisitions. They're only talking about getting rid of the tax benefits of real estate.
Who does that hurt?
Well, that hurts the family farms. It hugely hurts the family farms, hurts the small business who owns they own their own building. They're wanting to sell their building. What they want to do is they really want to trade into, let's say, a triple net lease on a Walgreens, something like that, and have a nice, reasonable income for their retirement, right? We're talking about retirement assets of entrepreneurs. That's what we're talking about. And what you're talking about is the entrepreneurs, they don't really need retirement assets. What we really need is we need the big corporate America to actually own those companies and be able to take them over. So seriously, these are conversations I'm having with clients right now, Patrick, is that if this capital gain, if this goes through, then it will completely change the way a small business exits, the small business owner exits their business, because no longer will they be able to just sell it for cash and pay a small capital gains rate. Instead, what they're going to have to do is they're going to have to sell to a big business, because the only way they can, the primary way to avoid that big capital gains rate, because remember, they're only over $1 million once in their lifetime, and it's when they sell their business, right? So the capital gains on business is a little like, Patrick, if the day you retired, your entire 401k plan was taxable. It's the same effect, right? You didn't get taxed when you took it out. You get taxed the day you retire. Well, the same is now, that's what they're proposing for business owners. So what happens is instead businesses are either going to have to aggregate and become big, or they're going to have to sell out to a big business. Those are really the two choices that they're left with.
Out of all the tax increases that we can have, right? Ordinary income, okay, fine. Capital gains, fine. Real estate, we got certain write-offs that we got going on. We got corporate taxes. Which one hurts the economy the most when we raise it? Which one hurts the economy the most when we raise it?
Oh, I think the taxes on small business hurts the economy the most. The capital gains tax probably has the least beneficial, it has the least benefit, because what it does is, remember also that, capital gains tax will definitely have a downward effect on the market, right? Downward pressure on the market, because people won't want to sell, they'll hold on to it longer, people won't be buying as much. And so what happens is that hurts the 401ks. Okay, and it's average Americans who own 401ks. It's not the big guys who own 401ks. You're not finding rich people with lots of money in 401ks outside of maybe Mitt Romney. And so what happens is that the capital gains tax doesn't raise much money, but it does hurt a lot of people. So I actually think from a policy standpoint, that's one of the, to me, that plus the capital gains at death, that whole capital gains scenario is, to me, probably the worst part of this. The corporate rate, they can raise that 25%. I don't think that hurts a lot. I think, the international rules, they've got to be really careful with, because that could have a huge impact. That was probably the best thing, by the way, that came out of the 2017 Act, was the corporate international rules. Those were actually—
Can you go deeper on that? Unpack that?
Yeah. So, we had this before 2017, we had these corporate inversions. This is where Apple, for example, they did this, right? They have a small company in Ireland, which has a 12% tax rate, basically acquires Apple. It's kind of a minnow swallowing the whale type of thing. And now we have all these earnings that are outside of the US. Well, Apple can't bring them back in, because if they bring them back in, they pay 35%, right? They've got to leave them outside the US. Well, what the FDII rules did was allow you to have these earnings from intellectual property at roughly 13.5%. Okay. So now we've had, by what I've seen, the calculations I've seen, about $1.6 trillion brought back into the US as a result of the changes in these rules. Well, so let's say you get rid of those rules. Biden's talking about a 28% tax rate, not a 13.5% tax rate. Well, now what do you do? Well, unless you can, in la la land, you can have a worldwide minimum tax, but that is purely la la land. Okay. That is never going to happen, because why would Ireland agree to that? And you have to get 100% agreement. It's never going to happen. So if you had a minimum tax, it may work, but without a minimum tax, what are you going to do? You're just going to go back to this corporate inversion. People will they'll just leave the money offshore. They can do that. It's just not that hard. I mean, tax planning is, when it comes down to it, once you understand the rules, it's just not that hard, Patrick. So, that's actually, frankly, what I liked best about the 2017 Act. I liked the reduction in the corporate rate, and I liked the international rules, the FDII, the GILTI stuff, even though they're very complex. I think they're a really good start in the right direction to really encourage investment in the US. What I would have liked to have seen was, rather than the Democrats arguing about, well, we need to undo this 21% corporate tax rate, is that I wish they'd said we need it to be at 15%, because that would then make the US a tax haven. Now everybody wants to be here. Okay. Instead of punishing US companies, right, and punishing people for locating in the US, which they are. Now, remember also, we don't have a value added tax. So, you take an example, if I can. Boeing sends an airplane to France. Okay. Not only do they pay corporate income tax in France, but there's a value added tax. Okay. 22%, right? But think about this. Okay. But Airbus sends a plane to the US. There's no value added tax. There's just a corporate tax.
Why don't we have a value added tax?
Because we have sales taxes, and we've never gone that next step to a federal level This is what really people like Ted Cruz have been arguing for, is a flat tax, right? Which is really a value-added tax. I mean, that's what a flat tax would be. It's a national sales tax. The concern, of course, is a value-added tax is an absolute fabulous idea as long as you don't also have a high income tax. But the challenge is that, once you get a tax, as you were just talking, right? So you were just saying, once you start that tax, it never goes away. I mean, it's permanent.
I mean, if we're going to tax anybody,
that's why we don't have one.
Why don't we tax other countries that want to do business with us rather than taxing? We're getting taxed when we're doing business with others, but we're not taxing them when they're doing business with us. And this is where the money's at.
Well, I'll tell you that's actually the idea behind tariffs, right? I mean, tariffs are the alternative to a value-added tax.
Trump did a lot of that.
Trump put tariffs on China. Yep. That's what tariffs are for, is to compensate. It's really that the opposite of the value-added tax. We don't have value-added tax, we have tariffs. And so when the other countries add tariffs, they're adding tariffs on top of their value-added tax. So it's still not an even. It's not an even playing field.
For the longest time, I mean, that's how the country ran, based on excise tax and tariffs that we had. That's kind of how a lot of the money was made. By the way, interesting fact, when we're talking about the war, how they raised, from 4 million people doing taxes to 41 million, and they raised from 900 million to $13 billion, a number I read you. Back when Lincoln was president in 1862, they passed a tax it was the first income tax they passed in 1862. No one paid it. Only the well-off, the rich people paid it. By the end of Civil War, only 10% paid the income tax. It started in 1862. By 1873, it went away, meaning, hey, we collected money, 11 years, we paid off the Civil War, now go back and don't pay any taxes. They did it the right way then, but now it's kind of like, no, keep paying it.
Well, and what happened was, Patrick, we got a constitutional amendment. That's what happened. So really, there was always a question whether a tax was even legal until we got the constitutional amendment, right, back in 1913. So taxes had to go away. They could only be done for certain short periods of time. With the constitutional amendment, that brought on the IRS and it made it permanent.
Going back to you saying you're talking to your clients, what are some of the common questions you hear your clients asking right now?
Oh, a lot of their question is, okay, what am I going to do to exit my business? What am I going to do from an estate planning standpoint? How do I make sure that all my money doesn't go to the government? What am I going to do about these capital gains? Here's an interesting one. So nobody's complaining about the raising the corporate tax rate. Nobody's complaining about the raise to 39.6%, the top rate from 37 to 39.6%. Nobody's talking about that. They don't like the 1031 like-kind exchange is going away. That's going to put a damper on the real estate market for sure. That takes liquidity out of the market is what it does. These capital gains, and 1031 is really a capital gains tax, right? That's what it is. So what you're doing is you just take liquidity out of the market, and nobody that's in the market wants to lose liquidity in the market. That's what makes the market work, is liquidity. And so I think that the capital gains tax is the one that's probably the most problematic. The reality is, Patrick, you could go back to a 70% or 75% tax rate over 10, 20, 30, 40, $50 million. Nobody would bat an eye. They wouldn't even bat an eye. Nobody's going to complain. Are there going to be fancy ways to deal with that? Yeah, of course. You got the money. If you got that high of a tax rate, you're going to play the games legally to make sure that you don't pay that high tax rate. Just like you were saying, like when Jack Benny did back in the early days. So this is where we are right now, and it's just really interesting to see. It'll be really interesting to see what actually transpires, and see if we get some cooler heads in there to say, you know what, we don't really want to confiscate business owners' retirement.
I think by the end of the year, it's a very likelihood that in 2022, man of the year could be Joe Manchin. I think man of the year in 2022 could be Joe Manchin, because he has more control than Kamala Harris. He has more influence than Kamala Harris. He's probably the most influential politician right now in America, because he's not willing to compromise certain values on helping advance the economy. And you have to respect the guy where he's at. But you're talking to your clients. Your client asks you, hey, Tom, man, what do I do? Do I sell my business? What recommendation are you giving? Are you saying sell this year rather than next year? Are you saying, look, are you keeping it for 5, 10 years? Who cares? Hang on to it. if you know, what kind of feedback are you giving to, I know obviously you can't give a blanket advice to everybody, but what are some of the feedback you're giving to your clients?
No, look, once you understand the tax law, you realize that there are a lot of different options. There are a lot of different ways to go. And you know, my job, for example, is to help you do what you want to do and not pay tax. That's my job. And so there are ways, there are always going to be ways to deal with this. Okay. We can deal with the capital gains tax. Now, what I am telling every client is do your estate planning now. You asked the question, Patrick, earlier, could they go back to the beginning of the year? That is really horrible, horrible policy. Okay. Could they do it? Maybe. I don't know. I mean, I'm not sure that that's legal to go back. Could they go back to today? Yeah. I mean, if you look at this 2017 Act, that was retroactive to September, right? September 27th is when those provisions were retroactive. Most of them were retroactive to September 27th. Well, that's when the legislation was first proposed. And so that's not unusual. Now, we don't yet have legislation actually proposed. We just have Biden's ideas. We don't have actual legislation yet. So what we're hopeful at, that we have this small window of opportunity right now to do some good estate and income tax planning. And they always go together, by the way. You never do estate planning without doing income tax planning. You have to do them together. But if you do that right now, there's at least a hope that you're gonna be within the window. If you don't do it now and you wait till the end of the year and it passes, then you know you're gonna be stuck.
States, a lot of people are looking into moving to different states. Okay, a lot of people. When I met with Arthur Laffer in Tennessee, I said, why are you in Tennessee? He said, it's the lowest all-in taxes in all of America. And he's not from Nashville, Tennessee. You moved this practice to Nashville, Tennessee. What are some states that are winning right now? What are some states that people ought to consider? And what are some deciding factors on somebody to sit there and say, I should look at this state, that state, and this state?
Well, first of all, look at all the taxes. Don't just look at income tax, okay? Because every state has to have money and they just get it different ways, whether it's sales tax or property tax, income tax. Those are pretty much the three legs of the stool, right? The income stool for a state. Texas obviously is winning. Florida is winning. Those are the two big winners right now. South Dakota should be winning, right? It doesn't have a tax. And like you say, Tennessee has they have a low personal income tax, but they actually have a pretty high business income tax. So it's Tennessee's probably would not be my first choice. I would probably choose a Texas, and Texas is even better than Florida because Florida does have a corporate income tax. They just don't have a personal income tax. Wyoming, Nevada, no income taxes. So I think those are kind of the winners. Of course, you have to look at, where do you want to live? I think that's more important. Texas does raise a lot of their revenue from property tax. So you have to look at, okay, what are my property tax going to look like? And do I even care, right? But it is those states with low income tax or no income tax that are really the big winners right now. I mean, take, I'm in Arizona, and the surrounding states, not Arizona itself, because we just increased our taxes by 80%. It's just lovely what we did. So now what we have is we have Utah, New Mexico, Colorado, all with much lower tax rates than Arizona. So I don't think Arizona is going to be the big growth state if this Prop 208 stands up in court. If it stands up in court, then I think that we're going to go the way of California. I think the West Coast and the East Coast, outside of, again, Florida, I think they're pretty much toast. People are just going to keep moving out unless they want to pay the high, what I call a beach tax, to live in those states. But the middle America, I think, is winning. They're winning with, they're winning. They've won throughout the pandemic, frankly, is that they've got lower tax rates. They are more conservative governments. And people are moving there in the droves.
First time in 172 years, California's population didn't grow. That's pretty insane to be thinking about that. First time in 172 years.
Well, and what did they do? They suggest we ought to have a 16.9% tax.
That's so. Why are you still in Arizona? Why are you still in Arizona?
Oh, I'm hopeful that the Supreme Court turns down Prop 208
Got it.
and we'll be okay.
There's a couple things that people, and this will be the last thing I want to address before we wrap up, is there's a couple things and then we'll wrap up with your book. There's a couple things that you'll hear about. So there's, oh, look, $1 million homes in California are selling like hotcakes. An article came out from CNBC today, record breaking. The average home stays on the market for 8 days before selling right now. That's insane. We put our house on the market, 24 hours, 2 offers done, cash deals, it was sold. And 2 years prior to that, I put in the market, 1 year I couldn't sell it. I put in the market 6 months ago, it just goes away within a couple of days. So people who are in money-making years of their lives versus people who have made the money in their lives, which means I'm 62 years old. I'm sitting on $17 million of money I've accumulated. Some of it's stocks, some of it's bonds, some of it's real estate, some of it's artifacts, collections, cards, whatever you want to call it. I got 17 million bucks. I'll move to California. I don't care about what's going to happen. I don't need to accumulate wealth anymore. I've already sold my little business, small business that I had, et cetera, et cetera. What is the different mindset on how somebody should be thinking about if they're in the prime money-making years of their lives versus somebody who has already made their money? What would you say to both of those audiences?
Well, I'll tell you, my clients, I mean, I just had a note from a client this morning, and he is moving to Florida from California. Why? Taxes. Pure and simple. My wife's also a CPA. She has a CPA firm. She has clients who moved from Arizona to Texas once Prop 208 passed. To think that people don't react to tax increases is pretty crazy, but because people do. So if you're, if you're earning a lot of money, or you're about to, how about you're about to sell your business? Get out of Dodge. Okay. Let's figure out a way to do that in such a way that you don't pay high taxes and lose half of your wealth to the government, because there are ways to do it. So it's not just what state you're in, but it's also the team you have around you, what advisors from tax advisors, accountants, lawyers, so forth. I mean, when they say that the rich don't pay a lot of tax, they kind of imply that it's because they're cheating. But what I find is that they just have better tax advice. I mean, that's all it is. And they're really doing things the government incentivizes to do. They're doing things government wants you to do. And so they pay less tax. I don't think I have a big problem with that.
What should I be thinking about when considering hiring an accountant? Like I've gone through good, bad, ugly, and great. What would you recommend? You're one, you've been in it, you've trained many, you've been around the block for a while. What should somebody consider? Because I've been part of a regional guy that's a smaller guy. And then when he came down to trouble, he bailed out. He's like, oh, you know what? It's just, I'm so busy. I'm like, what? Then I've gone to the bigger ones, Cohen Resnick, PwC, KPMG, BKD, all these other guys. And if one guy decides to change careers, at least the company still holds takes care of you as a client and stays with them. But from your perspective, what is the ideal criteria one should look for hiring an accountant?
Yeah, I've been with the big guys, as you said, and I've been and I've had my own firms for 25 years. So what I always look for is, are they looking at this from a transaction standpoint or from a relationship standpoint? Because if you're just looking at a transaction standpoint, you're really going to be very limited in what you can do in a single transaction. For example, somebody comes to you and says, okay, I've got this, I've got these new mugs here. Are they deductible? And it's the wrong question. The question should be, how do I make that mug deductible? Okay. How do I do what I want to do and pay less tax? Not how do I pay less tax? So what we look at, for example, what I teach people, my CPAs, we have a network of CPAs. What I teach them is look at the whole picture. Look at the estate plan, look at legacy, look at the income tax plan, look at what what do you want to do? Where are you in your life? You mentioned it. Are you in the high earning years? Have you made your money? Do you want to even leave money to your kids? I mean, my mother just wanted to break even. She didn't want to leave us any money. So she was fine just spending it. Well, if that's what you want to do, you don't have an estate tax issue, do you? So, looking at that all the personal aspects and what you really want to do. I mean, that's the question.
How do you tell apart? But how do you tell apart a CPA? Like, you can't really find that out in day one. You almost have to go on bet. So what is a process of saying, dude, is this a good guy, bad guy? Do I go through referrals? What are 5 questions I should ask the CPA when I'm hiring them? What should that relationship look like?
Well, I do actually go through that in my book, Tax-Free Wealth. So chapter 23 is all about finding the right tax advisor.
Perfect.
But nevertheless, I actually think it's more important the questions that they ask you than the answers they give you. So I think it's far less important if you're asking questions. The problem is you don't know what the answers are, so they could pull the wool over. I mean, you're not going to know whether they're right or not. What your advisor's for, it's like when you go to a doctor and you spend 15 minutes talking to the doctor's spending 14 minutes asking you questions to get a good evaluation of what they should do. And then they give you 1 minute of advice, right? Take this, do this, do this. 1 minute out of 15. That's what your advisor should do, whether they're tax advisor, legal advisor, or health advisor, is they ought to be asking you the questions rather than expecting you to ask questions and give you answers. They ought to be asking you the questions so that they can delve into that. We spend most of our time asking questions, not giving answers.
Phenomenal feedback right there. So since you brought up tax-free wealth, to finish up with your book here, a few things, a quick summary from your book. In the book, you talk about the fact that tax laws as written as a set of incentives, a way the government encourages certain activities that benefit the economy and promote social policy. You talked about that earlier. Vast majority of tax code is not written to raise money, but to stimulate growth. It's not about what you make, but what you take home at the end of the day. Everything you do either increases or lowers your taxes. Tax planning is not an end of the year activity, but a daily one. Tell us a little bit on what we should expect from your book.
Well, first of all, it's really easy. I mean, best review I ever got was that it was a great beach read. One person said that, another person said it read like a spy novel. So those are my two favorite reviews. It's not meant for this. It's not meant for a tax advisor. Okay, it is meant for the average person. And it's written for the average person. It's basically a lot of stories and a lot of explanation of how it really works in very simple terms. What you really ought to expect is a completely different way of looking at taxes. I think the tax law can be very positive from the standpoint that really it's not just a roadmap for reducing taxes, but it's actually a roadmap for building wealth. Just take a business deduction. A business expense is only deductible if it has a business purpose, it's ordinary, it's necessary, and it's documented. If we only, as business owners, only spent money that had a business purpose, was ordinary, necessary, and was documented, we'd make a lot more money. So I look at the tax law as a great instruction guide to building wealth. It's not just an instruction guide for reducing taxes, but they go hand in hand. You make way more money when you pay a lot less tax.
Like it makes a lot of sense. We're going to put the link to the book below. Tom, thank you so much for being a guest on Valuetainment.
Thank you, Patrick. It's been a pleasure.
Taxes, boring, but very important. Matter of fact, if you stuck around till the very end, just comment below and say, Pat, I watched the whole thing. Maybe even send me a tweet, because most people don't finish tax videos. I'm proud of you, because this is actually very important to learn about taxes. If you enjoyed today's video, you want to go a little bit deeper, I did a video reacting to Biden's proposed tax plan just about 4 weeks ago. If you've never seen it, click over here. And if you missed my interview with Arthur Laffer, which was 4 or 5 years ago, click over here. Take care, everybody. Bye-bye.